Our conversation with Jeffrey Gundlach, so you heard what he had to say.
Yes.
And it's good to have you here to react to this. Headlines from him: Fed should do nothing more.
Yeah.
Stop now. And that we're going to have a recession, that there's a 75% chance. What do you make of what he said and what you heard from the Fed?
So that camp has been growing, and we hear that again and again. And it's not people predicting the worst recession ever, because the one thing that you continue to hear is either rolling recession, meaning different industries experiencing it at different times, which I would argue we're in the midst of. Go tell somebody in the mortgage business we're not in a recession, they'll laugh in your face. So I totally agree with that idea. The other idea is mild recession and then mild recovery, because the tug of war of the largest forces that would influence that outcome is going to be one for the ages. Now you're in a situation where no matter what you do, the hurdle rate is going to be 5%. Do I buy this stock? Do I buy this fund? Do I want international stocks? Do I want large cap? Okay, will it do better than 5%? Sleep at night, absolutely no volatility, no risk. How many investments can you really say that about? So very oddly, the meme that's taken the market is, I want slow growth, reliable, high quality, dividend, high cash flow. I don't care about growth. I don't care. I'm not so sure that's going to be the case throughout 2023, because one of the things about markets where economic growth is tough to come by, the companies that do have a secular growth story actually tend to capture our imagination. And you're going to see some growth stories that don't require the Fed to be, quote, on our side. So I think it's going to be a little bit trickier than just buy the most conservative stocks, you'll be fine. That's what's worked in Q3 and now in Q4. I don't know that that's definitely the case next year.
What sectors are you thinking about will do better than others in the environment in which you describe a mild recession, mild recovery, muted stock returns?
Healthcare. If you are involved in names where they have a secular growth story that is not reliant on the Fed turning dovish or GDP growth beating expectations or any of the things that are probably going to be tough to come by in the first half, those are the types of stocks that other people are going to discover after you and pay higher prices for, because, again, growth will be scarce, and in the end, everyone's got to allocate somewhere. So, look, tell me, if you have an investment story you want to tell me why that is materially better than buying the BIL ETF at a 4% yield and not worrying at all about volatility. It's a tougher game to play than the game that we've been playing since 2012.
What do you make also of what Jeffrey said in the response to your question about international stocks versus U.S.?
I think it's interesting. You have high yields. You have companies that if you look at the European indices, for example, what are they overweight in? They're overweight in all the right sectors that are working in the U.S. They're overweight banks. They're overweight mining, believe it or not. They're overweight energy relative to what we are in our indices. So it's not necessarily all a dollar differential or interest rate differential story. Some of this is about literally industry group concentration in those indices. If I told you how well the FTSE was doing, you wouldn't believe me. It's shocking. Because
the narrative is the recession in Europe is going to be longer and much deeper than it is if we even have one here.
Look, the years where Europe does great and the U.S. is struggling are few and far between. I actually can't even think of one. However, if you've got this continued value trade in favor and the industries I just explained, if those continue to remain in favor, there's a very good argument why EFA could outpace the United States. And by the way, you're paying a much lower valuation to find out.